other aspect that we had discussed before is the proportion of funding by owners and the borrowed debt. The way we compare can be, we can take only the long term loans vis-a-vis the owners funds, or we can take long term and short term loans, means all interest bearing liabilities. We can also take all total debt irrespective of what it is interest bearing or not. Now let us look at this. This is the equity portion, which is your owners funds. This is the long term liability. We have broken up the short term liability into short term loans. So 125 plus 200 is the interest bearing part of the liability, and accounts payable, that is your creditors and others, are 115. They are still liabilities, but they are not interest bearing. So when we define the first part, we can have three different, as I said, ways of looking at debt over equity. So what is your debt here? Debt is all interest bearing debt. So your interest bearing debt of long term loans and the current liability of short term loans together gives you a figure of 325 over equity, which is your owners funds. So it is approximately 0.9 or 90% of the owners funds. Now this tells you what is the proportion of the debt in the overall with respect to equity. We can also have a situation where we compare equity over total funds. Now total funds would be nothing but the balance sheet amount, which is 800, and equity is 360. So it gives you, that is within the total funding structure, 45% or 0.45 is coming from owners, and the balance, which is total debt over total funds, which is 440, which is your 240 plus 200 is 800, 55% is coming from liabilities or borrowings. So this gives you an understanding of how much of these assets have been funded from borrowings and owners funds. This proportion is important, as I told you before, because every time you borrow, you have a legal claim. The lender has a legal claim on both interest as well as repayment of the loan, and this also commits the company to fixed cash outflows. That means you are already agreeing upfront that every 6 months you will pay the installment, you will also pay the interest every quarter, for example. Those kind of commitments is made when you take interest bearing loans from institutions and banks. So this risk, therefore, as the proportion of funds goes on increasing in the overall funding structure of the company, if the debt element starts increasing, this fixed commitment starts increasing, and therefore the riskiness of the company and its business also start increasing, because if there is some vagary in the marketplace where the operating profits falls substantially, then meeting these commitments could become a issue. But the question that arises, if it's so risky, why are firms raising funds through debt? Now that is because debt is relatively cheaper, less expensive compared to owners funds, because as we have discussed before, debt is a tax deductible expense. That is, before paying tax, you actually remove the interest cost and then arrive at the tax. To that extent, you save tax outflow, and therefore effectively the interest is a cheaper way of funding. But as we said, it also has the element of increasing the risk, but it also increases the return to the shareholders. So the ability of the management to balance this is very key. Let us see this with an example. Let us assume we have a situation here where the assets are known, that is your fixed assets and current assets are 60 and 40,000, totaling to a balance sheet size of 1 lakh. The sales is lakh and 20. The profit before interest and tax is 15,000. Say the interest rate is 10%. We will ignore tax for simplicity purposes. So how should the firm or this business or company should fund? How much equity and how much debt? So let us look at the possibilities now. Now it could take 100% equity, which is 100, no debt, so interest is 0, PBT or profit before tax is 15. So, the ROE, return before tax, is 15 divided by 100, which is 15. So, 100% is now equity. In a second situation, we bring in 80% equity and 20% debt. Now, what happens then? Then 20 into 10%, which is the interest cost, which will be 2. Out of this 15, 2 will go. So, the balance PBT will be 13. But since the amount of investment by the owners, the shareholders funds, is only 80, the effective return generated is 16.25. So, bringing in debt, as we see, starts increasing the return for the shareholders. But if you look at the various levels of mix of equity and debt, we will start seeing that the returns to the shareholders increase. But at a level, in fact, of 90% debt and 10% equity, the return can be as high as 60% in this scenario. But then the caveat is that the risk, if the operating profits fall even by 5 to 10%, the firm may default in the payment of debt and interest. So, the idea is that the firm or the management of the company should be in a position to manage the debt equity in such a way where the returns are in an acceptable level compared to the other instruments which may give safer instruments like bank deposits and others, because the risk you take while you actually do business is also high. So, that return has to be compensated for, and the mix has to be such that the balance is maintained while a bit of risk is taken to enhance the shareholder return. It is not unduly high where the things could change drastically on a negative side if market conditions change or there are other events that happen which bring the operating profit down drastically. It is also determined by the industry in which the company operates as to what would be a good level of debt and equity, because of the industry practices, the debtors payment terms, the creditors payment terms, and so on and so forth. This is for your understanding, to ensure that while debt is risky, it also helps in increasing. So, it is a double-edged sword in that sense.